Something crazy happened with silver today. That's not coincidence, and Jpmorgan is right at the center of it. But the data suggests they just leaked their entire plan. I mean, you've seen silver crashes before, but this one's different. This time, a government mint broke before the crash happened. But what does this mean for silver investors? And why is a bank allegedly insolvent heading into Monday? Well, let me explain. Disclaimer. A source with high Federal Reserve clearance just confirmed something that should send chills down your spine. A bank is now insolvent after Friday's silver crash. We're not talking about being underwater on some positions, we're talking about completely liquidated, gone. This person told my contact they haven't seen anything like this since 2008. Except the situation we're facing right now is potentially 100 times deeper. Deeper than anyone in the mainstream financial world can even imagine. And here's the terrifying part for most people. The markets are closed. Nobody knows what Monday morning is going to bring. Most investors are heading into this weekend completely oblivious. They have no idea what might be waiting for them when trading resumes. But silver investors, we're about to find out if this is the moment we've been waiting for. Now, before we go any further, let me give you the context of what actually happened, because the numbers alone are absolutely staggering. Spot crashed as much as 35% during intraday trading on Friday. It dropped below $75 an ounce. To put this in perspective, this was the biggest daily decline in 46 years. 46 years. We're talking about the most violent single-day move in silver since the Hunt brothers era. The financial media is calling it a collapse, a bubble bursting, the end of the silver rally. But here's what they're conveniently not telling you, and this is crucial for every silver investor to understand. Despite this historic intraday crash, silver still closed the month of January in the green. It was up 19%. Let that sink in for a moment. The metal got absolutely hammered. It experienced its worst intraday performance in nearly half a century, and it still finished the month with double-digit gains. But it gets even better. This means silver has now risen for 9 straight months. 9 consecutive months of gains. That's not a bubble. That's a structural shift in the market. That's a trend that no amount of paper manipulation can permanently suppress. Now, here's where the story takes an absolutely wild turn. This is where Jpmorgan essentially leaked their entire playbook. Anyone paying attention can see it. If you look carefully at the latest COMEX report, and I mean really dig into the data, you'll see something that should raise every red flag, especially for anyone who believes these markets move on fundamentals alone. Jpmorgan closed $1,959 silver short positions. They closed them at exactly $75, not around $75, not near the bottom, exactly at the bottom. At the precise moment, silver hit its lowest point and began reversing. This wasn't luck. This wasn't good timing. This was surgical precision. This was a trading desk that knew exactly where the floor was, and they knew it before the crash even happened. Think about what this means. The largest bank in America has more derivatives exposure than any institution on the planet. They closed massive short positions at the exact mathematical bottom. This happened during a 46-year historic crash. The exact moment silver stopped falling and started climbing back up. Jpmorgan was covering shorts. This is their way of communicating without actually saying anything. This is Jpmorgan's version of saying to the world, "We're done suppressing silver. Time to pump." Their order flow just told us everything we need to know, especially about what's coming next week. Let me know in the comments. Do you think Jpmorgan's timing was coincidence, or did they just accidentally leak their entire plan? I want to hear what you think is happening here. This isn't conspiracy theory anymore. This is right there in the COMEX data. Anyone willing to look can see it. when the biggest player in the silver market closes shorts at the absolute bottom. And with that kind of precision, they're telling you something. They're telling you the suppression campaign just ended. They're telling you they flipped from short to long. They're telling you that $75 was the floor, and they have no intention of letting it go lower because they're now positioned for the upside. For silver investors, this is the signal we've been waiting years to see. Jpmorgan doesn't make mistakes in these markets. They make the markets, and their trading activity just confirmed the bottom is in. The next leg up is about to begin. But the story gets even more interesting, especially when you look at the physical silver market. While paper was getting destroyed on Friday, something unprecedented was unfolding in the real world. Australia's Perth Mint suspended sales. They stopped selling their 2026 Kangaroo 1-ounce silver bullion coins. This is one of the most respected government mints in the world. Now, you might be thinking, okay, a mint paused sales, so what? But here's the detail that changes everything. This decision was made Thursday morning, before the historic $25 silver crash happened. Read that again. The Perth Mint was already at the breaking point. Silver was trading near $117. They were already so overwhelmed with demand, they had to stop taking orders. They even implemented monthly allocation systems just to ensure all regions get some stock. Their official statement to wholesalers said this: they have a large backlog of orders and they need to pause taking wholesale orders until February 23rd. This is to clear the back orders. Think about the implications here for silver investors. If the Perth Mint was already breaking under demand pressure that was at $117, what do you think is happening right now at $75? We're talking about a $40 discount from a level where they were already rationing supply. This isn't just increased demand, this is about to be a tsunami. Every investor who was hesitant at $117 is now backing up the truck at $75. Every person who missed the rally from 30 to 100 is getting a second chance. Every industrial user who needs physical silver is locking in supply at these levels. And the Perth Mint, a government-backed institution, is the first domino to fall. The first major mint to publicly admit they cannot meet demand. So the question every silver investor should be asking is this: which government mint is next? And more importantly, what happens to premiums when multiple mints are rationing supply while paper prices are suppressed? This is where all these pieces start connecting into one coherent picture. It's a picture that explains why a bank might actually be insolvent right now. Think about the mechanics of what just happened. You have massive short positions in the paper silver market. Positions that were likely taken when silver was much lower. They were betting on a return to $30 or $40. Then silver goes on a 9-month tear, climbing month after month despite every attempt to shake out weak hands. These short positions are getting squeezed harder and harder. The losses are mounting. But instead of covering, instead of taking the loss and moving on, someone doubled down. Someone believed they could break the rally with one massive coordinated slam. And that's exactly what Friday looked like. A desperate attempt to break the bull market using overwhelming paper selling pressure. Drop a comment below and tell me, did you buy the dip on Friday, or are you waiting to see what Monday brings? I'm really curious how silver investors are positioning themselves right now. But here's where the plan falls apart. While paper silver is crashing 35% in a single day, physical demand is exploding. The Perth Mint is already rationing. This happened before the crash even happens. Industrial users are scrambling for supply. Silver investors who understand the manipulation playbook are buying the dip aggressively. The disconnect between paper and physical becomes so extreme that it breaks something in the system. Maybe a bank that was massively short, expecting silver to collapse back to $50, suddenly finds itself on the wrong side of a physical delivery squeeze. Maybe they can't source the metal to cover their shorts. Maybe their collateral just evaporated when silver held 75 instead of crashing to 50. Whatever this specific mechanism, the outcome is the same: insolvency, complete liquidation. And now we're heading into Monday with that bomb ticking in the background. And this is where Jpmorgan's timing becomes even more significant, especially for silver investors. They closed their shorts at the exact bottom. They knew 75 was the line. They knew physical demand would overwhelm any further downside. They positioned themselves for the bounce because they have access to information retail investors don't. They can see the stress in the system. They can see which institutions are on the edge of insolvency. They can see the physical market breaking in real time. So when Jpmorgan covers shorts at the bottom with surgical precision, they're not just making a trade, they're confirming that the manipulation just hit its limit. They're confirming that trying to push silver lower from here would break something too big to hide. They're confirming that the next move is up and they want to be positioned correctly when it happens. The thesis that's emerging from all of this is profound, especially for anyone holding physical silver. For years, we've talked about the paper manipulation of silver prices. We've documented how a small number of banks can move the price using massive derivative positions that have no connection to physical supply and demand. We've watched silver get slammed during thin trading hours with coordinated selling that defies any fundamental logic. But what if Friday was the moment this system finally broke itself? What if the gap between paper prices and physical reality became so extreme that it created systemic risk? What if a major institution just found out the hard way that you can't keep shorting something when physical supply is this tight? The Perth Mint breaking at $117, a bank allegedly going insolvent at $75, and Jpmorgan closing shorts at the exact bottom. They all point to the same conclusion. The paper manipulation game just hit a wall and can't break through it. So, what does all of this mean for you as a silver investor heading into next week? First, if there really is a bank that's insolvent due to silver positions, expect some kind of intervention or bailout announcement. The Federal Reserve and Treasury Department aren't going to let a major institution collapse, not over commodity positions, without doing something. But that something usually involves printing money, providing liquidity, and creating the exact conditions that make precious metals more valuable. Second, physical premiums are about to spike hard. The Perth Mint is already rationing supply, and that was before this crash created a buying frenzy. If you're looking to add to your physical silver holdings, expect to pay significantly higher premiums over spot price, especially in the coming weeks. The discount you're seeing in paper prices isn't going to translate to cheap physical metal. Third, and this is critical for silver investors to understand, this price disconnect represents opportunity. When paper markets are selling off in panic, while physical markets can't meet demand, that divergence doesn't last forever. Eventually, price has to reflect physical reality. Eventually, the fact that government mints are rationing supply has to matter more than what some algorithm does, especially during low-volume paper trading. And when that reconciliation happens, the snapback in price can be violent and fast. We've seen it before in precious metals, and all the signs suggest we're about to see it again. Fourth, remember that despite this historic crash, silver is still green for 9 consecutive months. The trend hasn't broken. The bull market is intact. What we just witnessed was likely the final desperate attempt to break the rally before physical reality overwhelms paper fiction. And based on Jpmorgan's positioning, based on the Perth Mint breaking, based on the whispers of bank insolvency, that attempt failed. The smart money is covering shorts at the bottom, not adding to them. That tells you everything you need to know about where we go from here. The key for silver investors right now is to focus on physical metal, not paper prices. Paper silver can be manipulated down to any level, at least in the short term. Big banks can create selling pressure out of thin air using derivatives and futures contracts. But they can't create physical silver out of thin air. They can't make the Perth Mint suddenly have unlimited supply. They can't make industrial demand disappear. They can't reverse 9 months of consecutive gains with one violent shakeout. What they can do is create opportunities, especially for those who understand the difference between price and value. Monday morning is going to be fascinating for everyone watching the silver market. Are we going to get confirmation of bank insolvency? Are we going to see emergency Fed interventions? Are we going to see more mints announcing supply constraints? Are we going to see Jpmorgan's surgical bottom picking validated with a strong reversal? We don't know yet. But what we do know is that something significant just happened in silver. The largest intraday crash in 46 years, combined with government mints rationing supply, combined with the biggest bank in America covering shorts at the exact bottom, combined with rumors of institutional insolvency. This isn't normal market action. This is the kind of chaos that happens. It's when a manipulated market finally meets unmovable physical reality. Comment below with your prediction. What happens on Monday? Are we going to see silver rip higher, or is there more pain coming? And more importantly, which mint do you think breaks next after Perth? For silver investors who've been stacking physical metal, who understand the supply-demand dynamics, who've watched the manipulation playbook for years, this moment is exactly what we've been preparing for. The system is showing cracks. The paper price is diverging from physical availability. The big players are repositioning for the upside, and silver, despite everything thrown at it, closed January with its 9th consecutive monthly gain. The bull market in silver isn't over. It's just getting started. And if the rumors about bank insolvency are even partially true, next week might be when the mainstream financial world finally wakes up. Wakes up to what silver investors have known all along. This market is broken. And the only question is this: how spectacular is the break going to be? Especially when physical reality finally overwhelms paper manipulation. But what is your opinion on this? Comment down below if you're curious to find more. Then make sure to click on one of the videos you see on the screen. And with that, we come to the end of this video. If you enjoyed this video, then turn on the notifications bell on this channel. Missing an important silver update might make you lose money, so don't risk it. Also, please share this video with as many people as possible. Let's get this news out.